In this short presentation, I want to sum up the main measures that came out of the last budget for savers and investors. This is just an overview and it is targeted at just the measures within the budget that are relevant directly to retail savers and investors. So with no more ado, the earth didn't move. Basically, this was not the scale of budget we had, say, 12 months ago when the Chancellor signalled some major changes to the way that pensions operate from this April. This was more of a political tinkering act ahead of a general election, and the measures reflect that. So we got the budget on the 18th of March. Compared to previous budgets, particularly the last one, not quite as earth-shattering. And Labour have committed, although you never know with politicians, to not reverse any of Osborne's measures from the current budget. So we'll assume for now that these measures will stick, regardless of what happens over the rest of this year. Okay, so what were they? I've grouped them into three batches: general changes, specific changes to ISAs, and specific changes to pensions. Okay, the general changes first of all. Personal allowance, that's quite nice, that's useful. The amount that you can earn tax-free. Basically, it doesn't matter whether you're a higher rate, basic rate, a taxpayer, the amount you can earn tax-free increases by £600 to £10,600. That's good. And the basic rate tax threshold actually edged down slightly to 31,785. And this is the 2015-2016 tax year. It's the one that starts on the 6th of April 2015. Now, a measure of interest in particular to basic rate taxpayers, the first £1,000, according to George Osborne, from, note the date, April 2016, of interest on savings, that's bank and building society deposits, for example, is going to be tax-free, assuming that measure sticks, assuming that the election doesn't change things and Labour commit to that promise as well. So that'll mean that lots and lots of people, indeed the majority of savers by number, will be taken out of the requirement to pay tax on interest, and that's before you consider a cash ISA. Just note that for higher rate taxpayers, the total amount of interest you can earn reduces to £500, and if you're lucky enough to earn over £150,000, you don't get that benefit. Main rate of corporation tax reduced to 20%. All right, that is quite significant for, in particular, small and medium-sized businesses and so on, but I'm going to focus here on measures as they affect retail investors and savers. The inheritance tax nil rate ban remains at £325,000. Very straightforward, for example, for a married couple to double that if they plan, but essentially that hasn't changed. That's the amount of your death estate, if you like, that is not hit by inheritance tax at 40%. And the capital gains tax annual exemption edges up a fraction to £11,100. So that's the total amount of profit you can make, for example, from selling shares. That is tax-free within the tax year 2015-2016, and that's again before any extra benefit or shelter you might get in the form of an ISA. Now, moving on to ISAs themselves, first of all, the contribution limits have moved slightly. So 2015-2016, so from April the 6th technically, we're up to 15,240. All right, don't forget that as a married couple, for example, you can get one each. So that means you can shelter quite a chunk of your investments and keep them free from further income tax and further or any capital gains tax. Because don't forget that £1,000 new exemption I mentioned only kicks in from April 2016 and is only for interest on cash, bank, building society deposits. So you'll still want to be using your investment ISAs or the investment side of it. JISAs, that's junior ISAs. We've popped the annual limit, that's the amount you can invest within one tax year, up to 4,080, so a small change there. Now, the most interesting measure in terms of headline generation is probably this one. More on that in just a moment. The new Help to Buy ISA from autumn 2015. All right, that was the measure that's grabbing all the headlines, and the Chancellor's done something to pensions, which is a little unfortunate in order to try and pay for it. More about it in a moment. And new rules, for those people with ISAs, that's worth bearing in mind. New rules will effectively, to translate that sentence, allow you to do something that was pretty difficult before. In the past, if you basically set up an ISA and then withdrew funds from it, you effectively lost any future tax benefits on the money. It was deemed to count towards your subscription limit. Well, in the future, what you'll be able to do, we think, it'll all have to be within one tax year, some of the details still to be hammered out, is withdraw funds from a cash ISA and then reinvest them and potentially be able to preserve the tax benefits. Why is that useful? Well, it's useful in the context of maintaining, say, a rainy day fund. In the past, people might have been a bit nervous about having their rainy day fund of 3 to 6 months' salary in an ISA for the simple reason if they'd have to call on it, then they sacrifice some of their future tax benefits. Well, this measure should, devil's in the detail, make it easier for people to think, actually, I could keep my rainy day money in that tax shelter. Now, Help to Buy, what's all that about? It's a political measure designed to help first-time buyers. So once again, frustratingly, the government have gone for tinkering with the demand side of property without solving the supply side, you could say. The solution to more people being able to get on the property ladder is to build more houses, one could argue. This doesn't do anything for that side of things. It simply tries to stimulate extra demand at the kind of first-time buyer part of the market. So what have they done? You need to be a first-time buyer to qualify. Again, the details are still being hammered out at the moment. What the government said is there is a bonus potentially of 25% of the contribution that you make to this ISA from the government. All right. So the way that works is you can open one of these accounts. Again, the devil's in the detail. It looks as though you'll be able to put, say, a maximum of £1,000 initial deposit in, then contribute a maximum of £200 per month from then afterwards, and each month the government will in effect top up what you put in by £50. All right, but that means that basically in order to get the maximum sort of £3,000 contribution, you're going to have to be attacking this thing and saving away for 4 to 5 years. So it's not an immediate handout from the government, it's a kind of staggered one. And cynics would say that the people who've already got the ability to save a deposit are just being given a little extra boost from the government, okay, albeit over a few years. It's only available through banks and building societies, it would seem, all right? So this is a way of saving a cash deposit, potentially for a property, not a way of sort of speculating through risky investments via a new style of ISA. And there's another set of criteria too. The maximum value, it would appear, again, this is all to be confirmed, it would appear the maximum value of property you can be targeting to buy using this scheme is £450,000 in London and £250,000 elsewhere. So there you have it. An attempt, some would say, is to take a bit of wind out of Labour's sails, but nonetheless, the government targeting first-time buyers, saying, we will give you a little bit of an extra handout if you save via one of these accounts over an appropriate amount of time. You could receive up to £3,000 of extra help from the government, and has to be said, £3,000 as a return on what's effectively 12 from a first-time buyer. That's the maximum amount, if you like, to take you up to kind of 15 in total. £3,000 is a pretty healthy return on that overall account. Now, pensions. This is the final area I want to take on. How's the Chancellor planning to pay for things like Help to Buy ISA? Well, the answer is partly right here. A little bit unfortunate, the lifetime allowance will be reduced from 1.25 million to 1 million from the 6th of April 2016. In other words, the total pot that you can save up as a pension and just withdraw normally from has been reduced as someone who's not in a state pension or not in a final salary scheme offered by a company to £1 million. And just people think, well, £1 million, that's still loads, isn't it? Well, actually, at current annuity rates, if you want RPI linking and so on, that only buys you around £28,000 to £30,000 of pension. All right. So some people would say, on the one hand, the government wants people to save for their retirement if they're not in a final salary scheme or they're not in a state scheme, but at the same time, they keep making it more difficult to do so. Nonetheless, that is what the Chancellor has gone for as a measure. More about that in just one moment, just to sum up one or two other points. Lifetime allowance protection, we think, will be introduced to protect individuals with funds over 1 million. So there'll be people there thinking, well, hang on a minute, I'm there already. Is this going to mean I'm suddenly hit with some new penalty? And you'll see what that penalty could be in a moment. The answer is probably not. Stress the word probably. And from the 6th of April, there's a proposal to allow the sale of lifetime annuities for a lump sum too. So a wee bit more flexibility around annuities. Now, just going to finish on this idea of the lifetime allowance. That's in many ways, one of the bigger measures in the budget and one of the less favourable measures for pension savers. Let's take a look at it. So you are putting contributions into a fund, let's say a money purchase scheme, a defined contribution scheme. So here's roughly how this is going to work. The maximum amount that is not subject to the lifetime allowance tax rules, if you like, the extra tax, is £1 million. Any excess is subject to an extra charge. All right, taken as a lump sum, it's subject to a fairly hefty 55% additional charge, and taken as income, it's taxed as a 25% additional charge. So, in other words, in here, you've got a pot, and the rules say, even with the new flexibility coming this April, the rules say essentially 25% of that can be taken in tax-free lump sum. All right, and then it's up to you what you do with the rest, but essentially whatever you decide to do with the rest, whether it's draw it down flexibly, take it all in one go, you'll be hit at your marginal income tax rate. All right, so that's the deal on the first 1 million. On the excess, they keep pulling down where the excess kicks in, you're hit in effect with those two kind of penalty taxes potentially. The way that will work is, imagine the excess is 100,000. All right, so the bit over the top is 100,000 up the top there. Just give you a flavour. In effect, if you try and take that as a lump sum, it's immediately reduced because of that lump sum penalty tax to £45,000. So if you think, oh crikey, well, that's a bit penal, right, so I won't do that. What I'll do is I'll turn it into an income. Then the amount available to convert into an income is only £75,000 because you've lost 25% automatically. All right, now you could then go out and buy an annuity, for example. You can see that there is an immediate sort of penalty applied to the excess above the lifetime allowance. That was a very rapid summary of some of the key measures that affect savers and investors from the latest budget. Any questions, please send them to the usual place, editor@killick.com.